Good morning, everyone. Hopefully, everybody is enjoying this wonderful Sunday. And I'm sitting here going, I can't believe I am not prepared because I am missing something. But give me 2 seconds and I will bring it up and we will get this show on the road. Please feel free to leave a comment and I will definitely answer comments and everything at the end of the video. So go ahead and add comments and we will get there. All right. So I need to just upload something very quick. And there we have it. Can't believe I was unprepared. Well, not that I was unprepared. It was just that I did not have everything loaded. All right. So let's go ahead and add this to the stage. Remember, this is not financial advice or any other advice. This is just Brad out on the internet. So hopefully you enjoy in your morning. All right, so let's go through what I hold, what I think, and I'm just sharing what I have. First of all, I have my equities. Anybody in my circle community knows this very well. I sold a majority of my SPY. Yes, I did. I will go into that later into the episode of what I did and why I did it. But I sold a majority of my SPY. Still hold some. I got QQQI, NEOS. They do very well. And I'm going to show that on the chart. QDevo. Everybody should have a little QDevo. Just kidding. Up to you and your financial, where you are in your life. I also hold KQQQ from Curve. If you don't know, they've upped their distributions to 18%. And there's one thing that Howard said during my last interview is yeah, they got enough money to pay that for the rest of the year. If you missed that in the video. So it's like, yeah, I'm going to take that 18%. Thank you very much, Howard. I enjoy it. Plus, he has protective puts on that right now to protect the NAV. 18% with protective puts. I'm good. I like that. Of course, I have T-SPY and TDAC. They've done extremely well. You can't complain of what they're doing, and they're paying you that yield. Now, I also have GPIQ just as a base. It does very well too. You can't complain about any of these funds. I also have in my basket, because I started using baskets of Fidelity, I have QQQM just sitting in there. Now, I use that QQQM every now and then. I swap it back and forth just in case I need to buy a hedge because there's a little bit of market uncertainty. But hey, I hold it in my portfolio. And I'm going to actually show you what my yield is for the total portfolio closer to the end, maybe in the middle of the video. So you see the whole kit and caboodle. Now, one thing I said on here is I have single stocks. Okay, Brad, with singles? All right. So if you go to the next one, you see that I have some of the Round Hill single pairs, and I have some from Rex. I have a mix, but I also have a lot of the underlying assets in there also as a small percentage, just in case we have a little bit of run. But I'm going to point out two in there, Lays and Zip. By the way, I'm going to actually go ahead and show you what my growth portfolio was since April. Because if you've been following, I sold everything in my growth side. And then I got back in April when the market started going back up. When you see what I bought, you're going to be like, he's holding back on us. But we're going to go ahead and move on. So, yes, I do hold some of the Round Hill 1.2% leveraged. Not a huge holding, but it does juice the returns. And I also don't hold WPay. Now, why not, Brad? Let's go ahead and address this right now. And it's because I don't have to. I looked at WPay and said, okay, MSTR is trending downwards. So I removed it. I have a basket. If it's trending downwards, why hold it? That is something to be thinking about. I don't need to because I'm in a tax deferred account. So I can buy in and out of funds without having to worry about it. I also get to rebalance every month. Just hit the rebalance button and it does it for me. So there you have it. The other one I removed is Berkshire Hathaway. Again, on a 6-month chart, trending downwards. Don't need to hold a fund trending downwards. You're using 1.2 leverage and you're buying something that has underlines that are trending downwards. Let's go with let's not put those into my portfolio. Costco, again, 1.2% leverage on something that is trending downwards. I'm going to go ahead and say I'm going to avoid that. So when people say Brad doesn't like WPay, well, not that I don't like WPay. I just don't want to hold a fund that holds stocks that are trending downwards in my portfolio. Just something to think about. Put a little bit of thought to it. Just don't buy a basket. Look what they're holding. And that's just me and my research and what my thoughts are. So yes, I do hold some of the round hill weekly pairs, but I don't hold the ones that are trending downwards. And I also use a proprietary software that tells me this so I can quickly look at it. It takes me a whole 2 minutes and they say, hey, oh, MicroStrategy's trending upwards. Let's add it to the portfolio. It's really quick, really easy for me to do. So why do I hold anything that's trending downwards, especially in single stocks? Because I don't need to. But let's go ahead and remove that and get back to what I'm holding. So that explains why I have some of the round hills, but not all of them. And I have some of the rec shares. I already had some of the rec shares, but you can see that I have COII in here, but we'll get into more of those here in a second. In my AI section, I hold, of course, NVII. I've never had to reinvest in this. I got it at a good price. It's paying me anywhere between 30 and 40% annually. It's just doing well. Also hold the TSII. I hold GPTY. I hold chat, which is from Round Hill. Somebody keeps on saying I don't like Round Hill, but somehow these funds end up in my portfolio. Don't understand how that works. So I own chat. And again, this is in a basket. So I can always go ahead and just hit rebalance, but I don't. I've been adding Chippy and Soxy. If you look at Chippy and Soxy, you just go, Chippy is doing extremely well, and Soxy's NAV is greater than the S&P 500. So why is what you're doing? And here's one right here. WPay and who is all you need? Yeah, so he owns downward trending stocks. Just thought I'd throw it out. I don't know why he would own downward trending stocks. And I don't know why somebody would just go ahead and put all their money into equities, because that is not diversification. That is just asking for trouble. But that's just me. I didn't know. I just go ahead and go with what I got. I hold business development companies, PBDC, ARC. These haven't changed. It's my same selection. I do owe you a business development update. They have been beaten down recently, so they're getting closer to the good buy range to average a little more into them. And there's a little contagion in the CLO market. So you'll notice that my CLOs are all gone, but have been gone for a long time. But you'll notice that, hey, business development companies, these are really my bond portfolio, let's call it, because they pay me consistently. I don't have to reinvest. And right now they look like closer to the buy bottom, but I'm going to wait until the last Fed cut before I start reinvesting back into them, just to average down a little bit. I still hold preferred stocks, PFFA. It pays me every single month. I do extremely well. I take all the distributions. Really, I've never ever had to reinvest back into it. And I'll take that 9% yield, 10% yield, whatever it is at the time, and enjoy it. I do have Bitcoin. All right, let's go ahead and face it. I do have a Maverick side of myself. So I got BTCI, I got Biddy. I part ETTY. Now, 38.50 ETH USD price. Don't overpay on something like this. It's just, you don't need to overpay, right? Now, let's go ahead and go with blocks. Another one, trending upwards, doing extremely well. Just added BITK. So the very first distribution was 300% yield. Well, if you watched my video with Matt Tuttle, and when you watch the upcoming video coming with Howard from Curve, don't rely on the first 3 or 4 distributions. That is not what the fund will pay long term. They all admit it. That's not the long term rates that they're going to pay. So just keep that in mind. Is selling 0DT options on Bitcoin. So they get the gap up and gap down, and they pay weekly. So we'll just go ahead and go with that. And I actually have HODL. So I have a little bit of Bitcoin in there, and I can hit the rebalance button. But that is just what I can do in the baskets at Fidelity. Now, my SPY I moved into the debasement trade with Curve, K Gold, and K Silver. This is my debasement trade. If you're not following the debasement trade, I'm not going to get into it. It's the devaluation of the US dollar, and we'll just go with that. You can Google it and figure out if that's something that you want to do. I don't recommend it for everybody because I'm not here as a financial advisor. I am only here showing you what I'm doing, and I am doing a little bit of the debasement trade because I think in the next year we're going to see more and more of that debasement come about. So you might as well be betting against the dollar going up in value. It's probably going to go down in value over time. So that is outside of, and that's the beauty of baskets. I can hold that in a certain basket, and this is my basket for long-term hold. I do have the IAUI from Neos, which is on gold, paying about 12%. I got the K Gold, K Silver. I have the junior miners, SLJY. I actually hold SLIJ, and I hold BAR, which is actual gold. And that also pays fairly good distributions. As a diversified portfolio, I have REITs. I do have some of the State Street, and I'm going to do a video on State Street and their yields because they have been doing fairly well. I do also combine that with the underlying, so I get the plus side as well as the income off of it, but it exceeds my 8% that I'm using to live on. But there you have it. I also have master limited partnerships. I will tell you right now, AMLP is on the block. It's on the block. As soon as Neos comes out with their version, well, AMLP will probably just be disappearing from the portfolio, but everything else I do hold. Everything in this is 1099. So don't anybody sit there with the little fingers going, no, you can't do that. Okay, 1099. Go do your research. They are not K1s. Anyway, we're just going to go ahead and move on. I do have FSCO. That is my only one that's on the senior secure loans. CLOs gone. Now, I did a video. I told you should buy Stark. I don't know. I just said Stark looked really good to me, so I bought Stark. STRC, my call space is 9213. I do believe if I go out and it is at real quick. So stretch, Stark, stretch. It's called stretch. It's at 99.38. And I got a cost basis of 9213. And I'm going to just take the 10.5% yield and live with it because that is doing extremely well. Don't think that I'm going to be moving more back into it. I'm just going to enjoy the gains and I'm going to enjoy the 10.5% that it's paying. And I might put a little more to it. Right now, I'm holding cash and I'm selling some puts every now and then to get my cash level up a little bit higher than settling with a 3 or 4% rate. I can sell a cash secured put, but if I don't need the cash that week, and do just fine, either on silver, Bitcoin, I don't know, socks, something SOXL. Because, of course, if you're going to do it, you might as well do it on a leverage version and go ahead and generate a little extra income if you need it. Now, I do have the whole high yield challenge going on. That is a new one for me. You got the new ULTI. You got K yield is what Howard's going to go with. I do put WPay in there against blocks, against Alti. Now, I look at this going, hey, who's going to win on total returns? And I liked what Howard said. It's not always just about total returns. It is total returns. And we're just going ahead and say a NAV that appreciates just so slightly. I don't need a NAV that jumps way up, but it needs to be appreciating. But let's go ahead and finish that up. Right now, my passive income, and this is according to Snowball, and it's fairly close. I'm not going to say that it's 100%, but it's fairly close. That's right around that 18%, and I generate about $170,000 a year in annual income. Now, I do have a growth side to the portfolio. I don't normally talk about this, but let's go ahead and I'm really embarrassed to show you what's in my growth portfolio. Just kind of embarrassed because I haven't shared this with anybody, but I hold TQQQ, SOXL, Nugget, and Lays. Well, that's what I hold. Yeah, that's in the last 6 months, it's up 105%, 294%, 110%, and 334%. As soon as I said risk on, I don't think people really knew risk on really meant for Brad, because he had some Berkshire Hathaway and he had some other stuff. He just went, eh, it's time to go risk on. Somebody told me to buy the market. I wonder who told me to buy the market. So I bought the market. Now, I will be changing this over the next 2 to 3 weeks, getting out of some of these and maybe just moving to the queues, but that is something that I'm going to be personally doing. Now let's talk about my equities real quick because I'm going to bring up one other chart. So I'm going to go ahead and point this out. I hold KQQQ, I hold QDVO, and I hold QQQI. And this is on a 1-year chart. And I compare it against the S&P 500. And I just go, why hold the S&P 500 when KQQQ is at 32%, QDVO is at 30%, and QQQI is at 26%, and people just want to hold the S&P 500. I think that I have shown more than once that I am a believer more in technology and technology base, but there you have it. That is why I sit back and go, maybe my yields are a little bit higher. Maybe I am on a little more of the risk side of the fence. But if you don't believe in technology, maybe you should start thinking of technology and AI. And if you watch Matt Tuttle's interview with me, he believes in AI. But as soon as the AI spending and infrastructure spending goes down, then it might be time to change to something else, or at least take a little bit of that risk off. But that is my personal opinion and my portfolio. So hopefully that gives you a little bit of what Brad is doing and what Brad is thinking, because it's all about the journey and not about oh, this one's better and that one's better. Because one thing that I don't have that I'm still thinking about adding is eggs or egg Q or one of those egg funds because they have protective downside protection and they fall into the same category as KQQQ and QDevo where they're beating the market. So that is something for you to learn or actually go do your own research on. So let's go through some of these and go through some of the comments. Lance has been around for a long time. Good. Rodham Cowboy. Yes, Larry. I just go ahead and throw it out there. Good morning, Sean. Happy Sunday. Good morning. Let's go through. Yeah, you know, you, you gotta have a shirt that shows Bitcoin because we all have Bitcoin. Health and wealth. I like health and wealth. He's a nice person, and his wife is nice also. I got to meet both of them in person. Good morning to everyone. Redfish always shows up. Good morning, guys. PLTR has earnings this week. That's good. Well, gave me my conversation about WPay. I just don't think that you should have all your money into one fund because it's leveraged. You might want to do a little more diversification. Just thought I'd throw it out. But that is all totally up to you. And it's all about your age, too. If you are younger, much younger, than living on your distributions and you still had a job, then you might want to do something like that. It kind of makes sense. But if you're older, well, maybe not. When you have no other income coming in, you might want to be a little more conservative. Yeah, GPTY has done well. Why get out of clause? Floating rate. Yeah, okay. Yeah, all right. So, why get out of clause? Because there is a contagion going around. You've seen massive outflows from the CLOs. It you need to do a little more research about what's going on there because some of these CLOs are down 20%. I got out a long time ago because there is a clear divergence between what we have in default rates and credit spreads. There's a divergence. That's not what you want to look for. If you're seeing that, you should not own them. I mean, when there's a divergence, it's just telling you that it's coming. So you might want to look at the divergence between default rate and credit spreads for the CLOs. I don't think everybody talks about that. Yeah, this last slide shows GPTY, Soxy. Yeah. Well, that's on my growth side. I do have some of those high players. Hybrid fish, yeah. Blocks. Blocks is doing extremely well. I have never had to put money back into blocks. The NAV continues to go up. You buy some of the dips when you can. I already have my holding. In fact, I have my holdings in all the equities. They're all in the green. I'm not really reinvesting too much back into the equities besides Chippy and Soxy, just because I don't have a very large holding of those two. Those are the two that I'm buying, but everything else, I'm just letting it ride. Don't need to continue to add and increase my cost basis. It's all about keeping a low cost basis. Yeah, blocks and BTCI can. All I want to say is Neos, Amplified, they all do extremely well. Do you reinvest your Chippy and GPTY distributions back into the fund? No, I live on them. I don't want to tell people that I don't have a job. I live on my distributions. But I just said that I am continuing to build out Chippy. GPTY is above my cost basis. And that's one of those rules. That's one of those little things that, discipline. 3.5% below my cost basis. If it's not 3.5% below my cost basis, why am I buying it? I don't know. just to raise my cost basis so one day it can be below my cost basis? I don't know. That's just that is why I've chosen the ETFs that I've chosen, because every one of them, well, I'm going to say I haven't checked recently, but most of them have positive trending NAVs. That is the way that I like the funds. Prefer not the funds that have negative trending NAVs. That's just me. I mean, I really like a fund that pays 10 to 12% and has a positive NAV of 3 to 4% a year. That's exactly what I'm looking for, because I'm in retirement and my risk level is different than somebody that's in their 30s. If you're in your 30s, maybe you do a little more of the round hill WPA, right? Because you have time on your side to recover. I don't have time on my side to recover, so I'm a little more conservative. Does it make sense to hold Chippy and Soxy? Well, I do. Just going to say, I hold both of them. And that's because you don't know which one is going to do better when, right? Everybody thinks, oh, I only need to hold one ETF. Okay, good luck with that one. TQQ, yeah, come on. Come on, put a little more risk in that life, right? Especially, I mean, I didn't come on and say risk on like screaming it, but if you if you had any clue what's going through my mind, I'm really was saying risk on, but there you go. But it's time to start taking some of that risk off. Just thought I'd throw that out. Uh, I was expecting Berkshire Hathaway and boo, come on, wearing a Bitcoin T-shirt and somebody's expecting Berkshire Hathaway. That's not how it works. When the first time I bought Chippy and blocks, the price was above my cost price. I wish I would have bought more. Yeah, it's ran away. It has ran away, and I am in the same boat. But I hold both of them. I am again buying Chippy a little bit at a time. All right, a little bit at a time. Uh, if you lean Nasdaq, why hold T-SPY? Well, that's actually a good question. You might see T-SPY disappear. Don't tell anybody. Now it's on the video. It might disappear. It might slowly disappear over time, because I lean more towards the other side, and you are correct. But at the same time, you just don't go around selling $100,000 of this and $100,000 of that and swapping it over here and swapping it over there. It's just something that I've learned over time that maybe I want to slow down. I'm a slow mover. I just don't go around and start trading every single day. I've had that for a long time and it's done well. Pays me 14%, but I hold just as much into TDAC. And I can't put any more into TDAC because that would like really blow up the which side of the portfolio that I have. But I do have a large holding of TDAC. Yeah, KQQQ has done great. Howard's going to be on the channel on Monday, and we're going to be talking about that one. Yeah, Chippy, good morning. QDevo, yeah. Is owning all these? Well, that's a good question. That's a very good question. Can you tell me which one's going to do better tomorrow? If you can, go ahead and buy what you think is going to do. We have different funds with different holdings doing different styles of strategies. I don't get it. And they also use trust, and all those trusts are actually in different banks. So you don't have bank contagion either. Something to think about. International funds, maybe. I do not have any real international funds because I think it's a good diversification, but I'm looking going right now. It's totally a risk on still for technology. Top of the morning. Do you recommend? I don't recommend anything. No, no, don't recommend. Uh, Look at those. Those are growth funds. I don't know. Depends on your age, your risk tolerance, and everything else. Just go through thoughts on why max versus why pay. I don't like holding negative trending stocks. I don't need to. You can buy all the funds in YMAX and figure out which ones are negative trending and not own them. Like, why would you own Misty? Why would you own YMAX with Misty going down over the last 6 months? Doesn't and it's the same thing with YPay. Why hold MSTR or what MSTW when it's trending negative? It doesn't make sense that people just don't want to do the research to figure out not holding everything is a really good thing to do. You might want to look at what's trending positive and own that. I mean, somebody put Hood, HOOW. It's trending positive. I can understand why people want to hold it. That that makes sense to me. But holding stuff that's trending negative, especially when it's leveraged, doesn't make sense. Are you buying the current dip on K Gold? I'm not buying any more of those funds. Soxy and Chippy. I do buy a little bit of BTC, and Biddy because they got down to the 107. And I said I was a buyer below 110. So no, no, I have my holdings. Actually, my long-term holdings are above my cost basis. So it's not 3.5% below my cost basis to lower my cost basis. So I can understand the question, but yeah. Good morning, Granite shares. Do you trust? Huh? I'm just going to go like this, going, it is all up to you and your investment style. Now, can you own Granite shares and pair it with the underlying and do okay? I think you can, but that is something that you need to backtest and figure out. And I am too old personally to be going around trying to figure out, do I own Granite shares when I can own something else that does very well? TDVI is an interesting one. Yes, it is. I've looked at that several times. It's not quite what I want in my portfolio, but it might fit into your portfolio. But it has done extremely well over time. I, I see that every now and then when I go look at them. Thanks, Harley. I forget. Yeah, I'm trying to do live streams every now and then. And how do we get 3.5% below cost basis? Why 3.5%? That's a good one. That's because it's just something I came up with. I just said one day I reached up in the air, 3.5%. Now, I'm going to go ahead and say I'm a little bit of a risk on type of guy. When the new NEOS boosted funds come out, I will probably pick up a small percentage, but I'm going to use 5% on the boosted funds because it's 1.5% leverage. So I only want to average down when I can and take the rest of it, hold it in cash, right? Do whatever I need to do with it. Try to buy something that's on sale, then trying to always average in. But that's just me in retirement. If you're not in retirement and you're 2 to 20 years away from retirement, you got time. I don't have time to recover. So that's why I look at stuff. Clause will have price change and distribution cuts. I don't know. All I want to say is there is definitely, if you do CLOs and my private community knows about it, there's a divergence. And I've been told about it by several hedge fund managers. There's a divergence between credit spreads and default rates. And when that happens, bad for credit. GLDW. Hey, look, pick your funds. Go out and look. Figure out, is that trending upwards or trending downwards? It's not for me to do the research for you. Tons of tools out there, stock analysis, seeking alpha. You can go type them in, take a pick, figure out if it's trending upwards, it's a buy. If it's trending downwards, might not want to buy it. Just thought I'd throw it out. Always follow the trend. Yeah. Uh, you might want to look at that. You might want to figure out if you want your whole entire credit risk, because I know Stephen Bavaria from the Income Factory is all about credit risk, but I think you need to make sure that you do a little more risk diversity. Like growth, Apple, Amazon. Yeah, there you go. SoxQ. Well, you got me on SoxQ. Let's see here. What is SoxQ? It's probably a leverage fund, but let's go ahead and say it. And somebody's going to ask me about TLTW. And I am going to continue to say long-term inflation affects TLT. So keep that in mind. It always keeps on drawing me in, but I'm going to say TLTW. Long-term inflation is something that you need to consider. That is just where I am going to go ahead and end this up and say, I hope you guys enjoyed this, and I will see you next time, and God bless.